We have known for almost a year that dark times are coming for the Eurozone. We are witnessing an economic collapse of the bloc. In a shocking admission, the former ECB president, Mario Draghi, has admitted that it's the end for the EU. There's almost no escaping this disaster. Draghi knows that Europe is falling behind the entire world, and he has given us a date of when a recession will hit. And this is important because if the world's third largest economy crashes, this could trigger a global recession. Listen to this. It's almost certain we are going to have a recession by the year end. It's quite clear that the first two quarters of next year will show that. Remember, a recession is two consecutive quarters of negative GDP. And that means the collapse might have already started in October last month, and it will be official by June 2024. And here's the situation. Draghi is on a mission by the EU to advise how the bloc can rescue their economy. He managed to save the euro a decade ago, so he's somewhat of a savior. But even he is giving up hope on the economy. Draghi knows the building blocks of a strong economic base have been destroyed. The moment Europe cut itself away from cheap Russian energy, its fate has been sealed, and Draghi has confirmed what we have known for a very long time. Where we need to get our act together is energy. We are going nowhere, paying twice or three times what it costs in other parts of the world. And this problem is only going to get worse. Look at the situation in the Middle East. Europe's energy supply of LNG is at risk if things blow up in the Gulf. Then we have winter coming and Putin ready to shut off gas supply whenever he wants. And remember this insanity. America sanctioned Russia's Arctic LNG project. That cut away France's supply of gas from the Arctic, and Putin could retaliate by cutting even more. Winter is coming and Russia still supplies at least 10% of Europe's LNG intake. If Moscow turns off the tap, the industrial collapse will get even worse. And here's the interesting thing. Draghi knows it's the blind following of US policy that's dragging Europe into this irreversible mess. America, they can withstand the sanctions imposed on Russia much more than Europe, and it's no longer a secret anymore. To survive, Europe has to act together and become a deeper union, a union capable of expressing a foreign policy and a defense policy. Europe has to think independently and not depend on America for everything for defense. And if they don't, they will forever be following orders from the White House. And understand the stakes at play. If Europe enters a recession, global demand is going to collapse. The production of the EU doesn't really matter because places like China can easily cover the world with cheaper goods. And what's problematic is the demand side, right? The more industries collapse, workers will eventually start losing their jobs. And when people lose their jobs, they have no money to spend. You don't have to be a genius to figure this out. We have already hit the iceberg, and the question is now, how bad is the flooding? In our lead story today, Eurozone inflation sinks to 2-year low as economy contracts. Yes, CPI might have fallen down to 2.9% in October, but Q3 GDP has crashed down to negative levels. And it's not just the rate hikes that's destroying the Eurozone, but the extreme cost of energy. Demand for EU goods is going down because prices are just too high. We can see inflation coming down quite rapidly. It's even lower than the US CPI now, but that doesn't mean GDP will grow. Over 50% of Eurozone GDP comes from global trade, from exports. Not only do we have a slowing economy, but imports from Europe are now costing more. They are priced higher. People in America are buying more locally while China is the king of cheap products, and that leaves the EU out in the cold. And that's why GDP has crashed to negative 0.1, even though inflation has dropped by over 1%. And let's talk about Germany for a bit, right? Because it's the poster child of what happens when you lose your trump card, which is cheap energy. The German industry shrinks more than expected amid recession risks. Production in September declined by 1.4%, while economists predicted a contraction of only 0.1%. So you can't rely on mainstream anymore. They have to hype up the economy to delay the implosion. German industry is crashing because we have a trifecta of storms converging. Interest rates are high, China's economy is slowing down, and energy costs are going through the roof. Companies, they can't expand because the cost of capital is higher and no one is buying their goods. But here's the nightmare fuel. It isn't just the automakers suffering, electronics and pharmaceutical sectors are in pain as well. So as long as energy is an input, industries will continue to crash. And I know what you're thinking, right? It's Germany's fault. Europe's biggest economy is going to take down the entire Eurozone. But you'll only be partially correct because it's not just the Germans. The entire bloc is in crisis mode. According to Eurostat data, French GDP is an abysmal 0.1%, Spain grew by 0.3%, and Belgium only by 0.5%. Then we have Italy stagnating, and economies like Austria, Portugal, and Estonia also contracting. We are seeing a complete takedown of Europe. And let's talk about Italy for a bit, right? Because it's likely the next casualty. Their economy is on the brink of a financial apocalypse, but wrong decisions are still being made. Italy is the third biggest economy in the bloc, so if it crashes or when it crashes, it adds more fuel to the fire. The Italian economy avoids recession by the narrowest of margins. This is cutting it really close. Yes, the economy technically avoided a recession, but this is nothing to cheer about. Looking at their GDP, Italy's growth in Q3 was virtually zero. They had zero growth in the last quarter. Yes, inflation has collapsed down to 1.8%. That's a good thing, but if we dig further, there are a ton of problems about to come crashing down as well. We know Germany's economy is powered by manufacturing, right? It contributes over 18% of their GDP. But guess who else is also dependent on their industries? It's Italy. According to the World Bank, 14% of Italy's GDP comes from manufacturing as well. So Italy is extremely vulnerable to high interest rates, soaring energy prices, and crashing global demand. If Russia decides to cut gas supplies to Europe this winter, Italy will also be affected. If the Middle East erupts into chaos, their LNG supply from Qatar could be disrupted. Looking at Italy's manufacturing PMI, the figures are not showing us a good story, guys. It looks very similar to Germany. Italian manufacturing has contracted for 6 straight months, and surveys are showing it's going to continue for 7 months as well. Things are going down. So Meloni's government is now in a quandary because money coming to the economy is slowing. She's resorting to the good old Keynesian playbook of deficit spending, and boy, is she going to rack up a big bill. She is forecasting a deficit of 5.3% of GDP this year and 4.3% in 2024. Those numbers are on par with American borrowing levels. Now, this is a big problem because the US can always print money to solve their debt crisis. Italy can't. Their debt has to be repaid sooner or later. Either the ECB has to bail out Italy again, or the Italians will have to make budget cuts, which will most certainly crash them into a recession. Or yes, they can always default on their bonds. That's an option, but it won't end well taking that route either. So if you're the Italians, you know you need to export more stuff to the world, you need to bring in more money to plug the deficit. But instead of working with buyers like China, you are following America's playbook to decouple. Maloney is now moving to break away from China's Belt and Road. And do you think that will make China happy, or do you think it will make China angry? It's decisions like this that truly make no sense. There isn't a need to rock the boat right now when we are all heading towards a global recession. This is a political move that has real economic consequences. Italy brings in almost $19 billion from China. Sure, they have a big trade deficit, but they are buying mostly raw materials to manufacture stuff. And if China has a choice between Italy versus another country in the BRI, who do you think they'll choose? There's now an added economic risk that wasn't even needed, wasn't even there in the first place. And speaking of bad decisions, this is where we round things off with the latest sanctions of the UK on Russia. The British government is now targeting Putin's gold. They believe Russia is laundering sanctioned gold around the world to evade sanctions. The British are now after Russian gold miners and traders in the latest package of sanctions. Now, gold is a big income stream for Russia's war effort, contributing over £12 billion a year. The UK wants to stop the movement of Russian gold into the market, and by imposing sanctions, they want to block the import of Russian gold into the UK. And this means traders and Russian miners can't bring their imports into the world's largest wholesale market for gold. In other words, they get cut away from a place with a ton of buyers to sell their gold to. So the UK is trying to cut away a big window of transaction. Fair enough, right? And yes, sanctions also mean if you deal in Russian gold, the UK could also freeze your assets. It's more or less the same playbook as the US, but this is where things all fall apart. It sounds nasty, it sounds really scary, until you realize that it's not. In fact, this will hurt the London gold market even more. Firstly, Russia buys a lot of their domestic gold reserves. Russia's gold reserves have increased by at least 1 million ounces since the start of the war. And we know they have fully de-dollarized their reserves, right? They have thrown out the euro as well. So the only options left are either the Chinese yuan or gold. And if they need to export gold bullion, they don't need to choose the UK. That's not the only option. London is not the only gold hub in the world anymore. Britain, they're stuck in the old order thinking. There are multiple places in the world that Russia can sell their gold to. There's the Shanghai Gold Exchange in China, and in the Middle East, there's the Dubai Exchange. The UAE last year imported 96.4 tons of gold from Russia. That's a third of their annual mine production, and this represents a 15-fold year-on-year increase of Russian gold. And this alone should tell you how ineffective gold sanctions truly are. It is as useless as oil sanctions as the oil price cap. There will always be buyers for gold because it is a reserve asset and it is essentially money itself. And even if Dubai doesn't touch Russian gold, China will be more than happy to take in every ounce. The Chinese would love to buy Russian gold at a discount, and there's a ton of room for savings. If we look at the mining cost of gold for Russia, we can see something very important. The all-in mining cost for gold in Russia has always been lower than the global average. In 2022, this difference was well over $250 an ounce, which is a very big deal. This price differential means Russia has a ton of room to sell gold at a huge discount without losing much profit. The price of gold today is above $1,900, so Russian miners are still earning the same as those in America or Africa. So good luck trying to block Russian gold from entering the markets. Even if the UK cracks down on the UAE, this will push Russian gold into the hands of China. And that's why financial sanctions, whether it's the US dollar, oil, or gold, never work in the long run. There are just too many loopholes you can't close. If the UK insists on squeezing gold traders around the world, more people will just leave the London gold market and head elsewhere, just like the effects of de-dollarization. Things aren't looking very good in Europe. We are seeing the effects of all the wrong decisions made all play out today, and it will be the same for the gold sanctions as well. And let's talk about Russia now moving to squeeze the West financially. Putin is planning to increase the 2024 budget by 26%. Spending is going to hit $380 billion next year. So oil revenues are going up and Russia's deficit is shrinking. So the ability to wage war is still there. War spending is going to fly to the moon. Zooming into the numbers, Russia's defense spending is going to skyrocket in 2024. It was around 20% of federal spending last year. Now it's going to hit nearly 30%. And this tells us that Russia is digging in for the long war. They are officially in a wartime economy and they're going to ramp up the pain in Ukraine. And here's how crazy things have become. The budget for defense is going to increase by 200%. That's more than any other item. It's going to increase much more than even social policy. And this is why Russia has been cutting oil production. It is to keep the price of crude as high as possible to rake in more money. And here's what Putin is trying to do. He's trying to get the West to either double down on their spending or potentially lose the conflict. The defense budget is going to easily exceed $100 billion. Here's the question, right? Will the US ante up the same for Ukraine, especially when Israel needs money as well? Can Biden shell out another $100 billion for Zelensky to match Russia? Because if they don't, Ukraine might be lost. But if they do, then we all have to prepare for a tsunami of bonds and a bigger debt burden. We are now in a battle of financial attrition. But let me know what you think in the comments below. Is Europe's economy truly doomed? And can the West continue to outspend Russia? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.